Welcome to the 7 killer trading mistakes that stop you from being profitable. I'm Benjamin Lee with Think Trade Think, and I have some incredible information that will help you to improve your trading by the time we're done here today. We don't have too much time together, and I want to ensure that you get all the information that you need to help get you to the next level in your trading. So let's just get right into it. Before we get into the 7 killer mistakes, I want to share with you some data that is very important for every trader to know. I think a lot of us entered into trading with some unrealistic expectations. We all believed that it was going to make us into instant millionaires. I can speak to that because that's the exact impression I was under when I first started as well. There are 4 very important studies on traders that we're going to go through. The reason I believe this data is important for every trader to understand is because it'll give you a sense of the true reality of trading. These studies will show you the unadulterated truths of what other traders actually experience. The first study we'll walk through is Hieronymus' study of futures traders. The second one we'll review is the Johnson report on day traders. The third report I'll share with you is Odeon's study of stock traders. And the fourth piece we'll analyze is Dalbar Inc.'s study of mutual fund traders. After we're done going through these studies, I'll walk through the 7 killer trading mistakes. The first report we'll look at is Hieronymus' study of futures traders. In 1969, Thomas Hieronymus was an agricultural economist at the University of Illinois, and he decided to analyze 462 futures accounts. He found that only 162 of those accounts made money, while the remaining 298 lost money. That amounts to 63% of those traders losing money. He decided to dig a little deeper and found that only 41% of the traders who transacted over 10 trades in a year's period made money. The majority won or lost a moderate sum of $3,000 or less, although some made and lost much more. But this was in 1969, so when you adjust it for inflation, that figure is much more respectable. Overall, the market showed a zero-sum nature because in this group, the net profits were approximately zero, so the 41% of the profitable traders took the money from the remaining 59%. The one-timers who only traded once lost 92% of the time. And the lesson here is a lot of traders enter unprepared, they take a loss, and then they quickly leave with burnt fingers. Those that stick around to play the game can be winners, but not the majority. Now let's move on to the next study. The second study we'll examine is the Johnson report on day traders. In 1999, Ronald Johnson was appointed by the North American Securities Administrators Association to create a report on the success and failures of retail traders. And what he did, he chose 30 random accounts from a retail trading firm, and although the sample size isn't that large, you can still draw some significant conclusions from the study. And what he found was that 18 out of the 26 lost money. In addition, the risk of ruin calculations on the trader's statistics found that 75% of those accounts were going to blow themselves out. And the risk of ruin is just a probability of an individual losing significant capital to the point at which continuing on is no longer considered an option to recover those losses. And furthermore, the 8 accounts that were profitable also had a very high risk of ruin. Only 3 of the 8 accounts that actually made money had a risk of ruin low enough to imply any significant success as a speculative trader, which is only 10% of the entire sample size. And the takeaway from this study are that the great majority of traders had a risk of ruin so high as to make eventual bankruptcy virtually inevitable. The traders with the shortest time frames lost the most money and had the highest risk of ruin, and the average holding time for winning trades was much shorter than the holding time for losing trades, which indicates that traders were cutting their winners too early but letting their losses run. Now on to the third study. The third study is Odeon's study of stock traders. Terry Odeon, then a grad student at Cal Berkeley, did 2 individual studies. The first one, he researched 10,000 discount brokers trading accounts between 1987 to 1993, and then later he repeated the same study on a much larger scale with approximately 66,000 households from 1991 to 1996. And what he found that as a group, all amateur investors underperformed the market due to the higher than necessary trading costs. In the sample, while the market went up an annualized 17% over the same period, the average trader only returned 15.3%. But the 20% of the traders with the highest turnover underperformed the most with only a 10% return. And the lesson we can pull from this study is that undisciplined and uneducated trading is hazardous to your wealth and your health. Now let's take a look at the last study. The last study we'll review is Dalbar Inc.'s study of mutual fund investors. This study found that investors were so woefully inept at timing decisions that they managed to underperform the funds that they were buying by a huge margin. How bad was this underperformance? In a study they did from 1994 to 2001, the average mutual fund investor only earned approximately 6% of the entire gain of the S&P 500. In other words, they missed 94% of the profit they would have made if they would have just left their money in the index. A second study they performed from 1984 to 1993 split mutual fund investors into two groups, the advised group and the non-advised group. The first group were the clients with financial advisors, and the second group were individual investors that didn't have any type of guidance from a professional. The advised group managed a 90% return, and the non-advised group only managed a 70% return. That might be considered a great return, but if you look at the return for the S&P 500 index during that same period, it's almost criminal. If either group would have just left their investment in the S&P 500, they would have received a 293% return. That's a difference in return of over 200%. And the main lesson we can pull from this study is that these investors' main problem was that they were performance chasers. They moved their money into the funds with the highest past performance and jumped ship when funds underperformed. This is another form of mistiming the market or buying high and selling low. Now let's take a look at what other roadblocks you may have to navigate on your road to trading success. Here are some of the roadblocks that I've seen that get in the way of the success of many traders. The first roadblock is an important statistic that most new traders ignore. 90% of futures traders lose money and blow up their accounts within 12 months. It's amazing how we always ignore the overwhelming negative data when we attempt to start a business or even begin trading. We always believe that we're different from everyone else and that the statistics just don't apply to us. We think that we're superior, we're smarter, we're better equipped than those people that failed. To be successful in trading, you must think and act differently than the majority. Think back to most of those conversations that you've had with other traders. I'm willing to bet it was probably about your trading system or methodology that you were using or the things that weren't working for you. Chances are that trading psychology or ways to improve your discipline weren't even mentioned. Do you really think that's that much of a coincidence? The second roadblock is for traders that have a stronger support system than individual traders. New traders at proprietary trading firms have a typical learning curve of 3 to 5 months, and even then, only 65% of them actually make money. The major differences between traders at a proprietary trading firm and retail traders are the nurturing environment, the mentoring, and the fluid exchange of information with their peers. Unfortunately for retail traders, we just don't have the same resources or conditions as other professional traders. So we must work even harder and more diligently than those traders, which leads us to our next roadblock. The third roadblock is that traders that we compete against every day have unlimited capital and resources. They have access to research and information that we can only dream of getting our hands on. The largest institutional traders have billions of dollars at their disposal. Some of them even spend millions of dollars per year just on their research analysts and information services like Bloomberg. They have access to people and information that we just don't have. The last roadblock is that their trading and execution costs are much lower than ours. One of the hedge funds that I trade for executes their trades at less than half a penny per share. Until we can reach the same transaction size as those institutional traders, it's impossible for us to get favorable execution costs. Lastly, what institutional and large trading firms have started to do is they started locating their servers at the exchanges. And what that does for them, it basically connects them to the exchange's internal network. This gives them actual real-time information and extremely quick, lightning-fast executions. But you would think with all their advantages, the institutional and proprietary firms would be, monopolizing the market. But that's actually far from the case. Even more and more retail traders are flooding the market because we can capitalize on the one thing that those larger traders can't, which is our size. Where they're big, we are nimble. Where they have large positions, with the ability to be more precise with our entries and our exits. Where they can move the markets with their size, our footprint is just too small to be noticed. We must use our size to our advantage because we have absolutely no chance if we attempt to mimic them. And success for us all starts with our trading psychology. Now that we know what stands in our way to our trading success, let's take a look at those things that we can correct within our own trading. As you can see by the information that I just shared with you, trading is one of the most difficult professions that anyone may ever attempt. Your strengths and your weaknesses are magnified because the market is filtered through your beliefs, your experiences, and your own emotional makeup. If you have trouble with discipline or risk management, it'll show up in your trading. If you're scared of loss, you'll ultimately lose. If you get emotional very easily, the market will make you emotional. If you don't know what you're doing, you'll eventually get run over by your competition. Trading is already difficult enough because, as I said in the previous slide, our competition has unlimited resources, better research, more capital, and even lower commissions compared to us. The odds are definitely stacked in their favor. And as I said earlier, over 90% of traders fail to make money and eventually blow up their account. Yet most traders don't spend the time nor the energy to attempt to stack the odds back in their favor. Most of the traders that failed in those studies underestimated the amount of time and dedication that they would have to spend to become part of the profitable minority. In the book Outliers by Malcolm Gladwell, he observed that it takes approximately 10,000 hours in any particular field to become a maven or an expert. If I told you it would take 10,000 hours to master trading, would you invest the time and do whatever it took to become consistently profitable? If you said no, I would recommend just hanging up your trading shoes and finding a new and safer profession. But if you said yes, prepare for one of the most fulfilling, exciting, and profitable professions you'll ever encounter. Every trader's goal is to become consistently profitable so they can leave their job, support or improve their lifestyle, provide for the family, and or fulfill some emotional needs. Whatever your particular goal or goals are, there is a road to success that you can follow to accelerate your learning curve and your time frame. After years of working on my own trading methodology and psychology, and working with hundreds of other traders, I have found 7 killer mistakes that will destroy any chance of you becoming consistently profitable. I'd venture to say that all of those losing traders in those studies had one or more of these mistakes apparent in their trading. As we go through them, remember how many apply to you. I'll provide a quiz at the end of this presentation for you to judge what you have to do to reach your goals. In addition, I'll give you some suggestions on what to do to correct any mistakes that you've been making along the way. The first killer trading mistake is having a trading system or methodology that doesn't evolve with the markets. When most traders first start out, they're typically enamored by the promise of riches from a particular trading system that works extremely well. The creators of the system brag about the profits that they're raking in, and you listen to their sales pitch and then you decide to purchase the system. You can't wait for that system to show up in your mailbox or in your email, and then you start reading it voraciously just to absorb all the information. You start trading the system, and that's basically where all the excitement stops. You begin to realize that the system works, but not as well as the creators said. You win for several days in a row, and then all of a sudden, you lose it all in one day. I know this firsthand because that's how I first started, and that's the same story I've heard from other traders. I personally have bought over 12 trading systems myself, so I completely understand that feeling. What most trading system developers fail to mention is the importance of context. In real estate, the 3 most important factors engaging a property are location, location, and location. The same holds true for trading, except it's context, context, and context. If you don't understand what the market is trying to do and how well it is doing in achieving that goal, entering a trade is basically just shooting a basketball through a hoop with your eyes closed. For some professionals that have the experience, they can sink a majority of their baskets because they have muscle memory and the experience. But for newer traders, your success rate is going to be much lower. This theory applies to trading as well. When an experienced trader utilizes a trading system, they're filtering that system through the entire database of price action and experience in their heads. Most trading systems tell you to enter the market after price has touched a certain moving average, has formed some type of candlestick, or after price bounces off a Fibonacci retracement. But unless you're looking at the context of the most recent price action, your odds of becoming consistently profitable are significantly decreased. And most trading systems are really good in certain markets and not very effective in others. The two major types of markets are balancing or rotational markets and trending markets. The trading system that is great in a trending market will get you in trouble when price doesn't trend and just rotates. A trading system that is great in rotational markets will get you killed in trending markets. The market only trends approximately 18% of the time and is in balance for the remainder of the time. So how do you take advantage of this? You either have to have two separate trading systems that work well in each market and learn to determine whether you're in a rotational and trending market, or find a trading system that teaches you the fundamentals of the market and the auction process and focuses on taking trades that have higher probability based on the current context of the market. The second killer trading mistake is listening to too many people for trading or investment advice. When you turn on CNBC or type in investing or trading into Google, there's no shortage of people trying to give you trading and investment advice. There's talking head after talking head telling you how the market is surging up or crashing down or giving their analysis of the market. With so many different viewpoints, it's very difficult to create a sound investment or trading strategy, let alone stick to it. Once you enter the market, you may hear or read several viewpoints that are opposite of the trade you just put on. That obviously will erode your confidence in your analysis and will make you second guess yourself. A problem most traders face that will hurt them in the long run is not finding a suitable mentor. If you look at the path of every successful person on the planet, at some point they had a mentor to teach and guide their progress. Having a mentor is very important because they understand the path you have to travel to reach your goals, and they can show you the best way to reach them. Also, they provide you with a third-person perspective that is unaffected by your own emotions. I would recommend finding a mentor that has exactly what you want and learn from them. Another issue most traders face is trying to do too many things at once. In trading, there are an infinite amount of different types of strategies, indicators, interpretations, and trading styles. It is very easy to get lost in the flood of information. It seems reasonable that the more systems you know, the better your results will be. But personally, I even subscribed to that theory and invested in over 12 different trading systems. I thought the more I knew, the better my trading would become. The exact opposite occurred because I was trying to do too many things at once and I couldn't focus my attention. I didn't improve my results until I simplified my trading system. Finding one system and one financial instrument to trade and becoming an expert in those is the best way to learn. You can add additional trading systems and filters after you've mastered each trading system and instrument. Just make sure you find a system that is based on the fundamentals of the market and auction principles. The third killer trading mistake is not treating your trading like a business. Did you know that over 65% of businesses fail within the first 4 years? There are a multitude of reasons why businesses fail, such as poor location, insufficient capital, lack of experience, competition, and even personal use of corporate funds. Does that sound remotely familiar to what you're experiencing in trading? A lot of those reasons are the same reasons why traders fail as well, except that the failure rate is much higher, usually at 90%. It's even harder for traders to become successful compared to normal businesses. So how do you start and maintain a successful business and/or trading career? When most people begin thinking of starting a business, they believe that having their own business will afford them more time and more energy. They don't realize that they're the final contingency plan when anything goes wrong. So in other words, they will have to work longer and harder than anyone else in their business because no one else will have as much invested or care as much as they do. Most new traders think that they can learn a trading system and just show up in the morning and be successful. But that couldn't be farther from the truth. I'm certain of this because that's what I originally thought when I first started trading. In the beginning, you'll need to spend hours and hours learning your trading system. And as your level of understanding increases, you will need to spend time watching and trading the markets. This will help you to get a feel for the markets. Then you'll have to work on your daily preparation and trading psychology. Until you log several thousand hours of work, you will need to focus a majority of your time learning as much as you can about trading and about yourself. In addition to the time and the effort you must spend, it takes a sound business plan and execution to create a successful business and to become consistently profitable in trading. A business plan creates a direction and framework for your business and your trading. An effective business plan will detail your goals on paper, how you're going to achieve them, and what your budget will be. One of the main reasons you want to create a business plan is to give yourself the opportunity to think about exactly what you want to do when you're trading. If you try to decide on a course of action in the heat of battle, chances are you're going to mix some of the emotions in with your decisions. Also, if you ever get off track, you can always refer back to your business plan. But even if you have the best business plan in the world, if you don't execute it well, you'll still be closing your doors or blowing out your account. You need to have the discipline required to execute that plan to perfection. Developing your self-discipline is a very important part of becoming consistently profitable. There's no one looking over your shoulder to make you keep with your plan. So you can be your own best friend or own worst enemy if you don't work on your self-discipline. The fourth killer trading mistake is not preparing yourself for each and every trading day. If you've ever watched your television before a sporting event, sometimes the cameras will show the players getting ready in the locker room or on the field. In the locker room, typically they'll be listening to music or getting their ankles taped or getting stretched. On the court of the field, they'll be warming up and stretching and getting their mind and body ready for the upcoming game or match. They have a specific routine that they go through before they go out and play. These professional athletes are paid millions of dollars to perform their sport at a very high level, so they know they must prepare physically and mentally to compete and to ensure that they don't get injured. And some traders are paid millions of dollars to make investment decisions just like professional athletes. We as traders also must prepare physically and mentally to compete in the arena of trading. We must prepare physically, but first, there are several areas that we must focus on. We must first complete homework to take into account the context of the market for that particular trading session. When we do our homework, we need to create a trading plan that has a minimum of at least 3 different scenarios. This stretches our mind and allows our creativity to flow. In addition, it'll prevent us from creating a directional bias and will allow us to focus on the information that the market is generating. Second, we must ensure that we have sufficient sleep, food, and hydration. If you're lacking in one or more of the areas, our body will not be in the optimum state to deal with the stresses from the market. Lastly, a workout routine will definitely help your body manage stress and achieve an optimal state. The most important type of preparation that athletes and traders must perform is mental preparation. Professional athletes have rituals that they rehearse to try to reach the apex of physical and mental execution called the zone. The zone is where an athlete reaches a transcendent level of performance, and Michael Jordan was especially adept at reaching that level. He used to visualize an entire game in his mind before he ever stepped foot on the court. He played every scenario that could ever happen on the basketball court in his mind over and over again. He was such a virtuoso with the basketball because he had already played that exact scenario in his mind before he ever saw it on the court. The mind is such a powerful instrument, but it cannot tell the difference between visualizations and the real thing. In other words, the mind fires off the synapses and the same neural pathways light up if you're visualizing or you're trading for real. Using a mental dress rehearsal before your trading session will help you keep a level head when different scenarios appear because you've already imagined it and visualized it in your mind beforehand. The fifth killer trading mistake is not measuring your results and not making the necessary adjustments to improve your trading. Every single year, millions of people perform a useless social ritual that has little meaning or even less impact on their lives. It always happens at the beginning of the year when people are full of hope and optimism. The ritual that I'm referring to are New Year's resolutions. It's amazing how many people make New Year's resolutions. It's even more amazing how many people forget them within a few weeks. I'm sure there are some New Year's resolutions that you've forgotten about through the years. So why do people never follow through with their New Year's resolutions? First, the frequency that they check their resolutions isn't enough. Typically, when someone declares their New Year's resolutions, The next time they revisit them is the following new year. The things that are in our face are the items that we take care of on a day-to-day basis. In other words, the squeaky wheel gets the grease. If you don't have those resolutions in front of you on a daily basis, life will get in the way and push those resolutions onto the back burner. If you never even see them again until the following year, you're going to let an entire year of your life pass by before you even see those resolutions again. Second, they never create a detailed plan to execute so they can achieve their goals. When someone looks at a significant goal and they don't break it down into manageable steps, they will automatically feel overwhelmed. For most people, when they see a very large goal in front of them, they start to find excuses about why they didn't or why they won't reach it. For instance, say someone is trying to lose 25 pounds. At first, they may feel like that goal is insurmountable because they have already tried every kind of diet or exercise program available. Yet all they would have to do is to shave 500 calories per day from their diet for 6 months. Basically, that's just skipping a venti cafe mocha from Starbucks every single day. When you break down a big goal into some smaller manageable tasks, it makes it much easier from an execution and a psychological standpoint. In addition, as you perform each daily task, you begin to build more and more momentum towards achieving that goal. Finally, the most important step is to measure and analyze your progress. As we move towards our goal, we need to assess how well our actions are moving us closer towards that goal. Do you know what percentage of the time commercial airliners are off course during their flights? They're actually off course more than 90% of the time. Yet, how is it it's extremely rare that a plane lands at the wrong airport? It's because the pilot knows exactly where their final destination is going to be. They have that clear goal in their mind. They make minor adjustments along the way to get back on course to reach their destination. That's also what we must do as traders. We should keep a trading journal and have a system to measure our effectiveness through time. If we can improve by just 5% every single year, that'll increase our bottom line exponentially. The sixth killer trading mistake is not working on or focusing on your trading psychology. If you've ever heard of the 80-20 rule, it applies just the same to trading. But the way I utilize the 80-20 system is, once you've internalized your trading system, trading is 80% psychology and 20% mechanics and execution. So after you've learned your system thoroughly enough where you don't have to think about what you have to do anymore, trading psychology is the most important aspect of trading. That's because the most dangerous person a trader faces every day is the person staring back at you in the mirror. You, and only you, have the ability to control your thoughts and your actions. No matter how great your trading system is, unless you've programmed it into a black box, you are still the person that has to press the button to execute the trades. And all your beliefs of the market, your good and your bad experiences, and your personality will filter that trading system before you ever make a decision whether or not to execute that trade. If your trading psychology isn't at its peak for every single trading session, your trading results will falter. We as traders must guard against anything that may negatively affect our trading psychology. Even if you do have a great trading system that provides a 75% winning percentage, you may begin to filter the trades with your less than optimal trading psychology and start entering the 25% of the trades that don't work. After you have several losses in a row, you'll begin to question your trading system and obviously yourself. One of the worst things that a trader can do is to start second-guessing themselves or their trading system. Confidence in your preparation and analysis is key to preventing that from ever happening. Your trading psychology is like a fragile bonsai. Bonsais are miniaturized trees grown according to a centuries-old Japanese art form. These trees are grown in very small containers and require a very strict balance of sunlight, water, and care. If you give it too much sunlight or water, it'll die. If you give it too little, the plant will not prosper. If anyone should know how fragile bonsais are, trust me, I should. I've accidentally killed 4 of them already. In the process, however, I've learned a great deal about the art and about myself. In the same manner, you have to ensure that your trading psychology doesn't swing too far from either extreme. If you aren't confident in your trading, it'll manifest itself as poor trading results. If you're too overconfident in your abilities, you may take too much undue risk or do something that will negatively hurt your trading account. Finding that perfect balance in your trading psychology is a constant battle where you must be vigilant and uncompromising. The seventh killer trading mistake is not taking responsibility or being accountable for your own trading results. I saved the most important killer mistake for last. Even if you can correct all the other killer mistakes, your trading will still suffer if you don't take responsibility or aren't accountable for your own results. When I first started trading, I thought all I needed was a trading system, and that would be the end-all be-all. I was quickly disillusioned after I took my first huge loss. I then began to think that there had to be a better system, or that knowing more systems would help me to avoid those losses. After I went from trading system to trading system, I still had poor results. After all was said and done, I invested and studied over 12 different trading systems. Then I began to realize that there was only one constant in that equation, and that constant was me. I had to stop looking for an external solution and start looking internally for the answer. When we always look outside ourselves for answers or for happiness, we tend to fall into a victim mentality. A person that acts like a victim always asks, "Why is this happening to me?" Or, "What did I do to deserve this?" A trader that acts like a victim always feels like the market or everyone else is out to get them. They always think that it's some external factor that's causing his or her poor results. This particular mindset is very debilitating because a victim does not feel like they can take control of their situation and make it better. Until they can step out of that victim mentality and own their responsibility, they will never be able to be consistently profitable. They may be able to make money here and there, but never to the point where they have the utmost confidence in their abilities. And for traders who want to reach that next level of trading, they must break free of the victim mentality and take control of their trading by accepting the responsibility of the results. The only way to do that is to make the decision that only you and you alone can affect your trading and therefore your results. Stop shifting blame on the market, the other market participants, or your trading system. Once you can accept sole responsibility for your results, you've empowered yourself to take any necessary steps to reach that next level. You'll be seeing the reality of the situation for what it is, and it'll free you to make new and important insights into yourself and into your trading. Now that you know some of the mistakes that can doom a trader's success, tally your results and take a look to see where you are on the scale and what you need to do to become consistently profitable. Count how many of those killer mistakes apply to you and see how strong your trading is. Here's a recap of all 7 killer trading mistakes. 1. The trading system doesn't evolve with the markets. 2. They listen to too many people for trading or investment advice. 3. They don't treat their trading like a business. 4. They don't prepare for each and every trading day. 5. They don't measure the results and make adjustments to improve their trading. 6. They don't work on or focus on their trading psychology. And 7. They don't take responsibility for their own results. If you have 5 to 7 of those mistakes, don't worry. You still have hope. You probably just started learning how to trade, and you haven't had the opportunity to focus on anything other than learning your trading system. If you've been trading for a while, I'm sure you're not happy with the results, and you're thinking there has to be a better way. Trading isn't something people know when they're born. You must learn it like everybody else. You just need to find a suitable mentor that will help guide you through all the trials and tribulations that lie ahead of you. When you're looking for that mentor, make sure they stress the importance of trading psychology as much as their trading methodology. You need to develop both aspects of your trading to become consistently profitable. If you have 3 to 4 mistakes, you're halfway there. You've started to build some momentum, and it's much easier to keep it moving forward than to stop and start over. This is a very critical time because this is where most traders become discouraged and quit. But the successful traders use their past experiences to galvanize and propel themselves forward to their goals to become consistently profitable. You have to decide whether you're willing to put the additional time and energy to reach that summit. I can speak from experience that once you get to the other side, all the trials and tribulations are worth the rewards you receive when you become consistently profitable. If you only have 1 or 2 mistakes, good job. You have definitely spent some time working on yourself and your trading psychology. You're really close to reaching that next level where you're consistently profitable. You're probably making more money than you're losing, but you're looking for that final piece to get you to that next level. If you spent years trying to figure this out, remember the reasons why you started this in the first place. The more reasons that you have, the more leverage and momentum you can create to push you to that next level. Don't get discouraged. You're a lot closer than you think. If you have none of these mistakes, congratulations. Most traders I talk to have at least one of these mistakes in their trading. That means you focus on improving your trading and maximizing your trading psychology. You've worked extremely hard and your persistence has definitely paid off. I must commend you on your dedication, because this endeavor takes thousands of hours if you don't have someone to guide you through it. Your results will speak for themselves. Remember, you will always have to focus on your trading psychology because each and every day brings a new challenge and new circumstances. Just stay vigilant and you'll continue to trade very well. And that concludes the 7 killer trading mistakes. I really hope you got a lot of value out of our time together. I'm going to give you even more value by sharing 2 things with you right now. First is the Market and Trading Launchpad, which is the outline behind my trading methodology and the steps I take to maximize my trading psychology every single day. You can find that at www.thinktradethink.com. There will be a pop under that appears at the bottom of the screen. Just put in your information and you'll get an email with a link to it. The second is a free 1-hour consultation with me where I go through everything you need to do to get to the next level of your trading. The only thing that I ask is that you fill out the trader assessment at www.thinktradethink.com/trader-assessment. Please take your time and really think through your answers thoroughly. The more information I have about you and your trading, the higher quality time we can spend together. I really enjoyed our time together and I look forward to meeting up with you along your trading journey soon. Until then, take care and trade well.